Let's start with a number that most people hear but rarely stop to think about. America's national debt has crossed $38 trillion. That's not a forecast, not a future estimate. That's the real number recorded at the end of 2025. For many people, it sounds abstract, too big to matter personally. But what's interesting isn't just the size of the number. It's what has been quietly happening around it. While most of us were focused on daily life, scrolling social media, watching shows, and moving on, something unusual began showing up in public financial data. The world's largest financial institutions started adjusting their positions, slowly, methodically, and without headlines. Large amounts of money have been moving away from dollar-based assets, not in a panic, not all at once, but steadily. This isn't a rumor or a conspiracy. These movements appear in Treasury reports, IMF data, and institutional filings that anyone can verify. And here's where it gets interesting. What's happening today fits a pattern that has repeated itself several times over the last 5 centuries. Different countries, different eras, same sequence of events. If you understand that pattern, today's numbers begin to look very different. A recurring historical pattern. Across modern history, major economic powers tend to move through the same 4 broad stages. Stage 1 is expansion. A nation becomes the center of global finance. Capital flows in, its currency becomes widely trusted. Trade increases, innovation accelerates. Confidence is high. This phase can last decades. Stage 2 is overreach. Success leads to higher spending. Governments borrow more, military commitments expand, debt grows faster than the economy. But rising asset prices hide the risks. Everything looks fine on the surface. Stage 3 is the quiet shift. This is the most important phase and the least visible. Institutions that closely study balance sheets begin repositioning. Capital slowly moves elsewhere, not because of headlines, but because of numbers. Stage 4 comes last. Confidence breaks, the currency loses influence, inflation rises, assets fall, and economic stability unravels. This pattern has repeated more than once. Let's look at 3 examples. Spain, the first case. In the 1500s, Spain was the dominant global power. Its ships returned from the Americas loaded with gold and silver. The Spanish real became the standard for international trade. Madrid stood at the center of global finance, but success led to massive spending, wars across Europe, military expansion, royal courts, and bureaucracy. Government expenses grew far beyond revenue. By the mid-1500s, Spain was borrowing heavily from European banks. At first, this didn't seem dangerous. Gold kept arriving, asset prices stayed high. Then something subtle changed. Major banking families began moving assets to other financial centers. Creditors demanded repayment in gold rather than promises. Interest rates on Spanish loans soared, some reaching 40%. Those numbers told a story long before headlines did. Spain defaulted multiple times over the next decades. Confidence collapsed, inflation surged. By 1600, Spanish dominance had faded. Capital moved north, toward the Netherlands. The Dutch Republic, financial innovation and overconfidence. In the 1600s, Amsterdam became the richest city on earth. The Dutch East India Company dominated global trade. The world's first stock exchange operated there. The Dutch guilder became the global reserve currency. Money flowed in from every continent. But wars returned with England, France, and Spain. Government debt expanded rapidly. Asset bubbles formed, including the famous tulip mania. Behind the scenes, the Bank of Amsterdam was lending depositor funds to finance government spending, a risky practice that remained hidden for years. Eventually, insiders began moving assets elsewhere. Operations shifted to London. Foreign investors quietly reduced exposure. When confidence finally broke, the Dutch financial system collapsed. The guilder lost its status. The Dutch Golden Age ended. Once again, capital moved on, this time to Britain. Britain, longest run, same outcome. For over 2 centuries, the British pound served as the world's reserve currency. London financed global trade. The British Empire controlled vast territory, but the 20th century brought 2 world wars. Debt exploded. Britain abandoned the gold standard. Economic strain became unavoidable. After World War II, capital and talent slowly shifted to the United States. Foreign investment declined. By the late 1960s, the pound was devalued. In 1976, Britain required an IMF bailout. Its era of financial dominance ended. The modern era. After World War II, the US dollar became the global reserve currency. Under the Bretton Woods system, it was backed by gold. Global trade flowed through American markets. In 1971, that gold backing ended. The dollar became a pure fiat currency. Debt began rising, slowly at first, then rapidly. U.S. national debt grew from under $1 trillion in 1980 to over $38 trillion by the end of 2025. Total debt across government, corporations, and households now exceeds $100 trillion. Interest payments alone approach $1 trillion per year. To manage this, money supply expanded dramatically. Especially after 2020, asset prices surged, housing, stocks, and bonds all rose together. This matches stage 2, the quiet shift today. Now comes the part many people overlook. Foreign holdings of U.S. treasuries have been declining. China has reduced its exposure by hundreds of billions of dollars. Japan, Saudi Arabia, and several European countries have followed. At the same time, large investment institutions have increased diversification into commodities, foreign infrastructure, and non-dollar assets. Trade agreements increasingly bypass the dollar. Alternative payment systems are developing. This doesn't happen overnight. It happens quietly, just like before. What history suggests next? Historically, when reserve currency systems weaken, inflation pressure increases at home. Governments face difficult choices. Markets become volatile. Economic transitions accelerate. This doesn't guarantee a specific outcome or timeline, but it does suggest risk. And risk is something history rewards those who prepare for. Practical takeaways. Understanding patterns isn't about panic, it's about awareness. Diversification matters. Liquidity matters. Reducing unnecessary debt matters. Skills, adaptability, and global awareness matter. Every historical transition created challenges and opportunities. Final thought. History doesn't repeat exactly, but it often rhymes. The same signals have appeared before. The same quiet movements, the same shifts beneath the surface. The question isn't whether history will change. It always does. The real question is whether we recognize the patterns early enough to adapt. This is Gossip Facts B, where we follow the data, not the noise. If you found this breakdown useful, share your thoughts below. And if you want deeper dives into hidden patterns shaping our world, consider subscribing, because the most powerful advantage isn't money. It's understanding.